Welcome back to Dvorkin on Debt, where we talk about everything money with our chief resident, Howard Dvorkin. How you doing, Howard?
I'm great, Sydney. How are you today?
I'm doing fantastic. You ready to get into it?
I am.
So, Howard, the Trump administration has proposed this new idea of a 50-year mortgage, and I just want to get your thoughts on it.
It's not a good idea. It's just a really, really bad idea because people are going to end up paying double the interest they're already paying on a 30-year mortgage, and they're not going to have any equity. And let's go through what I'm saying so everybody can understand it. When you make a payment on a house or even a car, but let's say a house, part of your payment goes towards interest, part of your payment goes towards equity, bringing the loan balance down. In the beginning of a loan, typically, the interest is paid more because your balance is more. Over time, your loan balance gets smaller and smaller. The problem is when you stretch out a mortgage for 50 years, you don't get to apply that much money towards the equity, towards the loan balance, so you don't end up with any equity. Won't be the American dream anymore. It will be the American nightmare.
What about it makes it actually not more affordable for buyers?
Well, let's use the average house in America, $400,000 roughly. Okay. That's the average cost of a house in the United States. The problem is you're going to pay $300,000 on top of the $400,000 in interest, which is $700,000. Mm-hmm. The challenge is if you stretch out the payments, yes, it will lower your payments by about $200 a month.
But there's always a but.
You're going to pay another $300,000 on top of the $300,000 you would on the 30-year mortgage. So you're paying $600,000 in interest on a house that probably isn't going to be standing there 50 years from now.
50 years is a long time.
And the other problem is the average homeowner in the United States flips their house 7 to 10 years. Mm-hmm. So guess what? At the end of 7 to 10 years, they haven't built up any equity because all they're doing is paying interest.
More and more.
More and more. And mm-hmm. So all you're going to be doing is selling your house, and you're going to be like, what did I make? Essentially, you're renting your house.
Do you think that this 50-year mortgage idea could lead to something that happened like the 2007-2008 recession?
I don't believe it'll be that harsh because there are restrictions in place, assuming those restrictions for home purchases are not lifted. The reality is, I think the market is going towards more modular built homes, mm-hmm. built in factories using robots, rolled in off a truck, and it's all set to go. Now, that's where I think it's going. You'll still have quite a few stick-built houses, but there has to be efficiency in building. They have to take the labor costs out of building. They also have to take the regulation out of building. They have to. If they don't, people are going to find it tougher and tougher to build a home.
Yeah, I agree. So what are the biggest dangers of this 50-year mortgage for the average consumer?
They won't have equity. That's the biggest danger. They mm-hmm. will not have equity. They go to sell their home in 10 years and they'll have this much equity. Yeah. And that's a shame, and more importantly, they're paying double the interest over the course of a 50-year mortgage than they would over the course of a 30-year mortgage.
Speaking of equity, how is this 50-year mortgage going to change the way homeowners build their wealth?
Well, they can't rely on their homes to produce wealth. And truthfully, you shouldn't. You shouldn't look at your house as an investment. It's a place to live. And I know people look at it because, frankly, they may not have anything else other than their house or a 401k. Mm-hmm. However, a house is a place you live, a place you use. It's kind of like your car. It's something you use. Unfortunately, the cars depreciate very quickly. Houses hopefully will appreciate. However, it's hard to see that an average house going above $400,000 in America, when that same house could have been $100,000 10 years ago.
Say you have this 50-year mortgage, but you don't plan on staying in your house for 50 years. Is that what happens?
You sell your house and you won't have any equity.
Is that more beneficial than actually staying in your house for that full 50 years?
Probably not, because you won't have any equity.
Right.
You just rented your house for the last 20 years or 15 years.
Right.
50-year mortgages is a bad thing, and it's a bad thing for many, many reasons, and it's going to cost people a ton of money, and they shouldn't be imprisoned, so to speak, for 50 years. That's a long sentence for anybody.
Right. So how can homeowners better improve affordability?
Require a course, a financial literacy course, so homeowners understand what they're doing. I know one of our organizations does first-time buyer training, and that's a tremendous, well-attended series of classes. The reality is it should be a requirement. For first-time home buyers, there should be an absolute requirement by the Fannie Mae or by the federal government, whoever's underwriting your loan, Freddie Mac, Fannie Mae, whichever organization, that they require financial literacy courses, first-time homeowner courses, and maybe give the people an incentive, maybe give them a little lower interest rate if you do take this class and you pass this class.
Yeah, benefits,
because it's going to make for a more knowledgeable, a well-informed future homeowner.
Yeah.
And that's important.
I agree. So what advice would you give to the policymakers who are thinking about passing this 50-year mortgage?
Don't.
Just
listen,
simple.
Don't ruin people's lives in order to get votes. Don't go through and think you're helping somebody when in reality you're not. I live and breathe this. I help people get out of debt, and millions of people we have gotten out of debt. And this is not a smart idea.
Well, thank you, Howard, for helping us educate everyone on this 50-year mortgage. And hopefully everyone has learned something. And if you want any more information, please check out our website, Debt.com, for all the information you want, tips and tricks. And thank you for joining us. Thank you, Howard.
Thank you so much, Sid.